Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we continue with our EIS Basics series, and we're going to talk about EIS tax release. Because we're talking about tax release, I want to give an extra disclaimer in that you may find the application of these is not necessarily that simple. And if you want to use these yourself, you may want to take professional advice and find a financial advisor who can guide you through how to use these best for your own particular circumstances. So, as I say, today we're talking about the tax release. Last episode, we introduced the idea of what the enterprise investment scheme is. And one of the main attractions to investors is that they're a very significant tax release. So a few years ago, there was a survey done by the EU, and the UK sort of tax advantage schemes, EIS, VCTs, SIS, were ranked amongst the top 5 most generous schemes in the world. So these are really quite significant. And while we talk about the attractions of companies and the returns you can get, one of the key attractions is these tax release. So we're going to work through them steadily. So the first one we're going to talk about is income tax relief. So this means that any investment can be offset, or a portion of it can be offset against your income tax bill for that year. So the relief rate is at the rate of 30%. So that means if you invested £10,000 into an EIS company or an EIS fund, then you could get £3,000 of your income tax offset against that. That applies in the year in which that investment is made. So if you're investing in a fund, you may find that even if you invested, say, in March in one tax year, some of the times the investment may not be made until the following tax year. So that is the tax year that applies to that. There is, however, something called carryback, which means that you can carry back that tax relief to the previous tax year. Right now we are in the 25-26 tax year. If I invested today, then I could claim tax relief against my income tax in 25-26, or I could also, instead, I could claim it in 24-25, or in theory, I could even split it across the two. So you have this sort of little perk on sort of timing. So that means that if you haven't invested promptly in one year and you invest the next year, you can still take advantage of unused tax relief in the previous year. You are allowed to do that up into £1 million of investment per annum. So in theory, you could save £300,000 of tax, income tax. We mentioned knowledge-intensive companies, which are companies that are particularly doing things that involve research or development, employ a lot of smart people, and the government is keen to encourage these high growth, and these have higher limits. So if investing in knowledge-intensive companies, you can actually invest up to £2 million a year in knowledge-intensive companies and get the full rate of tax relief. It's worth saying that this only applies as long as you hold the company for a minimum period. In other words, you can't invest day one and then get your money back sort of a week later. There's a minimum of 3-year holding time for EIS, as we talked about in the last episode. That minimum is, in practice, academic for most companies, certainly successful because they will take longer than 3 years to mature. However, if you do happen to get an exit or a sale before that, and you make some credit on that, so as long as you make a profit, then you will actually find that you have to repay the income tax relief. So even if that's 2 years, 364 days, that is less than 3 years. And unfortunately, you would have to repay that full income tax relief on that company. Now, hopefully that's okay because you're getting a decent return. But there are times when you may find that's more than just irritating. But sadly, that's something that's not necessarily under the control of the investor a lot of the time, because when a company sold is subject to the vendor and the founders, not necessarily something you as an investor can dictate the timing of. That, for most people, is the main relief, probably the one that most people take advantage of, and the reason most people invest for. There are some other reliefs that everybody should know about. EIS, you also have what's called a capital gains deferral relief. And what that means is that if you invest a capital gain, it doesn't need to be on startups, it could be if you sold a buy-to-let or anything, then you can defer the capital gains tax until your EIS investment is realized. Say you sell a property and that costs you £100,000, you get £200,000, so you got £100,000 gain. So you would generally have to pay CGT at whatever your rate is on that, less any allowance. If you took that 100,000 gain and invested in EIS, then you don't need to pay any CGT now. You can defer that until when you actually get the money back on EIS. And in the meantime, you can get the return on the EIS as well. So you can see that you don't need to get a huge return on that extra money. So if you get 30% return on that money, that's kind of covered your CGT bill alone. So being able to reinvest that is a think boon. And certainly if you've got a gain and you think about invest, and there's quite a wide window around that. Again, this is an area where I definitely suggest check the rules, check with an advisor about working that out in practice. The next relief is the one that we don't really want to have to take advantage of, but we will probably, is loss relief. And this is a very good relief because it means that if you lose money in investment, then you can offset some of that. You can offset against your tax bill. So the loss relief applies to the net investment. So say, for example, that £10,000 investment we spoke about, you got £3,000 out of your relief. Your net investment is £7,000. So if you get less than £7,000 back, then you can offset that against your income or capital gains and reduce your tax bill accordingly. So what that means is it reduces your net capital risk. So if you're, say, a 40% taxpayer, then you would get an extra 28p back. So in actual fact, you're only actually risking 42p on the pound because you've got that 30% income tax credit plus that extra 28p of loss relief. So, as I say, it's not something that we want to take advantage of, but actually it does matter. And with typical loss, if you think the loss rates, probably in venture capital, expecting maybe a third of companies, maybe a half of companies if you're unlucky to fail, you can see that could easily add 10 or 15% to your total return. So it is, definitely worth having. I need to mention dividends. EIS does not have any tax exemption on dividends. Generally speaking, any dividends in EIS and venture capital companies, it's going to be a long time. You're sort of saying actually it's going to be 5-10 years of investing before you actually the company's in a position where it's actually spinning off cash to a stage where it would consider paying a dividend. It still would be nice to have, but it's not tax advantaged. The final tax relief I want to mention is something that technically is not an EIS tax relief at all, and that is inheritance tax relief. So any investment in EIS qualifies under the business relief rules, and consequently it is either totally or partially exempt from inheritance tax under the same conditions as the business relief rules. So those are currently in the throes of being changed. The budget in 2024, the Chancellor announced that they were going to cap business relief on the full business relief is going to be available on the first £1 million investment, and then it will be 20% of the value, any value above that. So that's obviously going to apply here. So if your EIS investments are less than £1 million and you've got no other exempt assets, then you will get full inheritance tax relief on that. If your assets exceed £1 million, then you'll get reduced tax relief on the amount above that. The exception is if you're investing in AIM shares, which is allowed under EIS, and they do not get that £1 million exemption. So those are going to be half rated from whatever you hold. So that's worth bearing in mind if inheritance tax is part of the reason for your planning. Unquoted, maybe it'll be better things to do. So that is a very quick summary through the very quick run through the release. I will post links in the show notes. So as usual, you'll be able to get full show notes with links at hardmanandco.com/podcast. You can subscribe to the podcast, all good podcast services and players, or through the link in the show notes. You can also follow this series on YouTube. So you can always click subscribe there. If you like what you're hearing, then please tell a friend or a colleague. Give us a review in your favorite podcast app. Click like on YouTube. It all helps. Thanks for listening and watching. And we'll be back next week with an episode on introducing venture capital trusts.